asset case with general correlations. So if you can do that, that will be most elegant. Okay, and now let me share my screen to give you some feedback on assignment 1. And let me just share the email I sent to you guys. Okay, so I should be seeing the email I sent to you guys for assignment 1. So yeah, I kind of explained my marking scheme. So just so you know how you can read my replies to you. But that's not really that important. So the main thing is that, like, what I really want you to do is to make sure you have like a pretty good conceptual understanding of the topics in asset management and portfolio construction. And so one of the things that a lot of people made the mistake of was using prices to calculate the correlation, which at least in asset management, there may be, like, some other cases where that might make sense, but really for in asset management, like this doesn't it's not even meaningful. So it's just like a totally wrong thing to do. And yeah, so obviously it's good that you catch this now. And yeah, just to remind you, in like the lectures, like we've never, and even in the day 1 lecture where we I showed you how to calculate the Sharpe ratio, and I explicitly wrote down the equation for volatility. It was always like returns that were used, not prices. Okay, so that's the main point. And yeah, so I sent you a link to somebody that has a reasonably good response to this thing. That yeah, I think like prices are non-stationary. I think it's a good way to say it. Okay, so that was like the first, like, big conceptual mistake for you guys to clean up. So that's fine. The other thing that I don't think anybody did a good job of, which is like kind of the difference between doing an assignment for school versus doing quantitative work in a professional setting. And in a professional setting, so like, for example, if you're like working an assignment for me or some other quant manager, one of the first things we'll expect to see is that you validated your data, because invariably data will have issues like gaps or incorrect values or whatever. So like there's a lot of time spent on data scrubbing, and in fact, like, clean sources of data are actually quite valuable. So the most basic tool for that is just to visualize your data, because it's much easier for humans to pick out outliers and errors visually than it is from just looking at a series of numbers. The other thing you should do, and the idea is not to do particularly any one of those, but the idea is like should at least do one to protect yourself from making mistakes. But ideally, like, the best practice to do all of these. So you graph and visualize your data. You gather statistics on your input data. So minimum, maximum, maybe the volatility if the records make sense. So that should be able to pick up outliers. And then the last line of defense is to use, when you do your analysis, to use metrics that are designed to be robust. So in our particular case of the correlation, the concept is to be robust with respect to outliers. And some of you, depending on how you download the data, but there was some bad data in the Yahoo data, so you had like a very low value, and then it just went back to normal. So that's a perfect example of an outlier, and that outlier, in fact, destroys the correlation calculation using what you guys all used, which is the Pearson correlation. Now there's another correlation called the Spearman rank correlation, which the benefit of using it is that it's robust to outliers. So in other words, if you had used So if you hadn't done anything else, you still had the bad data, but you used the Spearman rank correlation to calculate the correlation, you still would have got the um, a reasonable answer. So just to keep that in mind, like there's a big difference between the level of quality in doing like an assignment, which you guys have been used to, versus when you're in the workplace. There's a whole additional level of expectations. So you should be aware of that. And obviously that's one of the purposes of this course is to prepare you to be working quants. Yeah, and then they had some more minor points here and there. So yeah, so one of the things was a lot of you talked about the oil going negative, but for the most part, again, this is an example of between like a class assignment and a a workplace type analysis. So in a workplace setting, all your analysis would have been far too superficial. And what I mean by that is you don't really address that. Well, why in this particular moment of time did the oil price go negative? Because all the things that you mentioned, all those reasons are still in place right now, but oil is actually doing fine. So why does your logic not hold now as opposed to then? And if I did drill down further, I think I would have focused on more technical issues with the oil price going negative. So, in other words, how many contracts were involved in going negative? Like, for example, I'm just making this up as an example off the top of my head, but let's say the normal trading in contracts is, say, I don't know, like 1,000 a day. And on this particular day when the oil price went negative, it was only like 10 contracts traded. So you could maybe attribute the reason to more like technical reasons. But anyway, so that's just maybe a theme for the assignment one was a larger theme was distinguishing between classroom quality responses versus professional quant analyst responses. Yeah, and there's a few other minor things. And then, yeah, somebody did a good job on the margin calculation. So it's pretty, so I just shared that with you as an example. Okay, so that was feedback for assignment one. So let me turn the sharing over to the course material and we'll start. Okay. So yeah, so we're actually at the end of this lecture. We'll be halfway through the course, and so actually I wanted to talk about Bridgewater first. So let me actually just go in order. Yeah. So when I was giving the course, this happened to I happened to see this a note from Bridgewater. And so it tied in very nicely to the course. So like I inserted it at the beginning, but it's a few years old now, but it's still relevant. And the point I want to make is that there are actually many ways to be very successful in asset management. And so we'll see some of those examples during the course. But one example will be Warren Buffett, who's just pretty much exclusively stock picking value investor. Another example would be the Yale endowment model. So you actually saw a clip of David Svensson, example of another very, very successful asset manager and very successful portfolio. Then we talked about, we haven't actually covered it in that much in lectures, but I've told you about the Jim Simons Medallion hedge fund, which essentially it's a pure quant driven program And we'll actually, in a couple lectures, I'll show you a video clip of him talking about his career path and his investing approach. Also very successful. And then another example is Ray Dalio from Bridgewater. And we've talked about him in the sense of creating an all-weather portfolio. So meaning, as a reminder, you invest in asset classes that will do well in different economic regimes. So high growth, low growth, high inflation, low inflation. So what this slide is showing is Ray Dalio talking about his approach to dealing with being in a low return environment versus other approaches. So he's at the, I would say, the reason why I mentioned that there are many ways to be successful in asset management is that sometimes different investors have such different beliefs that they're almost at the opposite end of their investment beliefs. So this is what Ray Dalio is warning against. He says, like, investors are increasing their exposure to equity-like, often illiquid assets. So what does that sound like? That sounds like exactly like the Yale model. That's exactly what David Simpson does. Whereas Bridgewater is saying, no, this is a mistake. What you should be doing is you should be increasing you should essentially be doing more following a risk parity approach. So the all-weather portfolio, Bridgewater, those are all like follow this risk parity approach. And remember, we talked about in risk parity approach, you want to bring all the asset classes to a similar level of risk, because the starting point of a 60-40 portfolio, 60% equities, 40% bonds, means that 90% of your risk is coming from equities. So Ray Dalio is advocating that you should actually not only buy more bonds, but you should actually apply leverage to those bonds so that the bonds have an equivalent risk weight in your portfolio. So it's just interesting that you can have these investors that have very different approaches, but yet they all will be successful, which shows that there's not necessarily just one path to successful asset management. Okay, so now I want to just pause and reflect on what we've covered and where we're going over this eight lecture course. So in the first lecture, we established the structure for how to construct an institutional portfolio. We talked about investment beliefs, and we talked about performance measurements and the Sharpe ratio. And then in the second lecture, I want to just revisit. And so the main message from the first lecture was that we broke the portfolio up into a liability hedging portfolio and like a performance seeking portfolio or maximum Sharpe ratio portfolio, which brings in the concept of the Sharpe ratio, and also brings in the concept of focusing on that universal maximum Sharpe ratio portfolio. And then in the second lecture, we identified that a portfolio is essentially static weights to other asset classes or risk premia. And in fact, we talked about the two main asset classes, equity and fixed income, and we derived the risk premia that you can expect from those asset classes. The last lecture on Friday, we talked about weighting methods, and we talked about how if you don't believe anything, you equal weight, and then the more you believe that you can accurately estimate inputs, you'll migrate from equal weighting to equal vol weighting to some kind of risk parity. And then if you think that you can estimate everything very accurately, then you do mean variance optimization. And we made the observation that probably the optimal approach in practice lies somewhere in the middle. So something like equal vol weighting or risk parity. And then we're going to spend the next few lectures drilling deeper into risk premia. And then we're going to wrap up the course with some special topics, which is like illiquidity and liability-driven investing. Okay, so that gives you kind of now that you're about almost halfway through the course, it gives you the roadmap. Okay, so yeah, just a refresh of lecture 3. So it was what I said before. And then as a reminder, we derived the minimum variance portfolio and the maximum Sharpe ratio portfolio. Okay, so before we get into the case, and the case we'll probably spend quite a bit of time on it, and then that'll take us to our first break. And normally this case will be done as an in-class exercise. So if we were physically in class, what I would do is I'd split everybody up into teams of like 4 to 6. They'd work on this case, and then I'd gather everybody's results and we compare the different groups' approach, and we'd gain some insights into portfolio construction from that exercise. But given that we're not in the classroom, instead I sent you guys the spreadsheet and this assignment. But what I'll do is I'll work through the assignment like on your behalf. So basically show you how I would do the assignment. And so it's a useful exercise for you to follow along with, and because it's like, you know, the courses, you know, asset management. Well, this is actually like building like we're actually going to build a portfolio, which is the core exercise of asset management. Now, this exercise is building a beta type portfolio. So we're using like you know, easily available asset classes. There's in the upcoming lecture, we'll do an exercise where we build a portfolio of like an alpha portfolio. So we'll put together a portfolio of hedge funds. So that's the 2 types of portfolio construction that we'll cover in this as exercises in this course. So the first one is just a very vanilla beta type portfolio. Okay. So, but before we get to that, just let me cover our special topic for the day. So the last special topic we dealt with like what type of places you could work at, where you'd work at, and the different types of roles in asset management. And in this one, what I'm going to do is kind of broadly review the skills for asset management. And so obviously there's knowledge of finance, and then I put like the big fields within these categories. So they're all listed here: capital markets, derivatives, etc. And one thing I note is that that if you're going to work in asset management, you typically don't believe in the efficient market hypothesis, because a lot of the actual activity in asset management is attempting to extract those inefficiencies out of the marketplace. Obviously, math is a big one, and then the fields in math are statistics, probability theory, stochastic calculus, matrix algebra, programming. So that can be any modern object-oriented programming language. So C#, good example. And then there's various languages like SQL for extracting data, manipulating data from relational databases. I'm sure you're all familiar with MATLAB, R. Probably in practice, some of you have done stuff in VBA just because it's so readily available that it's essentially like built into Excel, so it's readily accessible. And then Python, like it seems to be gained a lot of popularity in finance over the last few years, and it's obvious that you guys are doing a lot of programming in Python, so that's great. Then there's data and technology, so AI, crypto, big data, and finally economics, so monetary policy, fiscal policy, establishing where we are in the business cycle. And obviously, the expectation is that you're not an expert in all 5 areas, but if you have a powerful combination, like if you have pretty deep knowledge in 2 of them, that's an excellent combination. So, for example, if you're like, finance and math, finance programming, finance and economics, you can imagine how those are all good combinations, good backgrounds for particular careers in asset management. Okay, so now let's me switch to sharing, and we'll go over to the case. So I'll first show you what the case looks like. And it's pretty straightforward. We're given a bunch of asset classes, and what we need to do is come up with the weights to them so that we have an excess return greater than 3.5% and a beta less than 0.5. And you can only select from the assets in the table. Okay, so fine. And then there's a bunch of questions. So let me now switch over to the Excel. Okay, so this is what you guys have received. And actually I have my notes, so I just want to look at my notes for what the steps I went through, just so I don't skip anything. Okay, so yeah, so the first thing to note is, okay, so let's just take a look at this, what we're given. And so we're given 4 different categories of asset classes. So equities, fixed income, alternatives, and active strategies. We're given the geometric mean, Sharpe ratio, volatility, illiquidity estimate, and equity correlation. So the first thing that recall that the assignment is wants a excess return greater than 0.35. So we're not given the geometric return, and we're not given the we're not given an excess. Sorry, we want to calculate the arithmetic excess return. So and instead we're given the geometric return and Sharpe ratio. So what we could do is identify the risk-free asset, which you know is the cash 1-month deposit, because it has a Sharpe ratio of 0. So by definition, the risk-free asset is a Sharpe ratio of 0. So we could identify that as a risk-free asset, and then we could do the volatility adjustment to convert geometric return to arithmetic return using the geometric return equals arithmetic return minus 1/2 volatility squared. So you should be familiar with that formula by now. But there's another quick and dirty way we can do it. It's because the Sharpe ratio is the excess return over the volatility. So because we've got the Sharpe ratio and volatility, a quick and dirty way to calculate the excess arithmetic return right away is simply to use the volatility times the Sharpe ratio. So that's the first thing I'm going to do. So I'm going to add a column here for excess arithmetic return. Oops. Okay, and I want this as a percent, so I'm going to divide it by 100, and I'm going to format it nicely so it's a percent. And I have a habit of making sure, like putting any formulas I do, I color them blue just so I know it's a formula. Then the other thing I'm going to do is I don't want to have to get all these NAs, so I'm going to just put like if is blank. Just put in a blank. Okay, so there we go. And I'm going to put this end here. Okay, so now I'm good. So then the next thing, let me just check my notes. Okay, so I want to calculate beta. So This is actually some, let me just switch to the whiteboard to give you the equation. Um, okay, so the beta equals the correlation. So let's say like the beta of like asset I to the market is the correlation of I to the market times volatility of I divided by the volatility of the market. So for example, let's say you had equity, you leveraged the market portfolio up 2 times, and so the correlation to the market would be 1 since it's the same thing, but you'd be twice as volatile. So this ratio would be 2, and your beta would be 2. So that kind of makes sense. So that's the formula. Okay, so let me go back to the spreadsheet. And what I want to, so now I need to calculate beta. So that's what I'm going to do next. And then to calculate beta, I need to identify what we take as a market portfolio. And so in this particular example, we know that the correlation to the market to itself is 1. So that means we identify that in this example, we're treating the global developed equities as the representation of the market. So that's fine. And so then the beta is equal to the correlation times, well, actually, I'm going to use the same trick. So and I'm just going to replace this formula by the correlation times the volatility divided by the market volatility, which is this guy. And I've already actually named in the spreadsheet, I named, instead of having to put it like in $, I actually named it. So I use a name cell, so this comes up as market. So fine. So I'm all good here. I want to display the beta as numbers actually. This is just my kind of pet peeve, but anyway, I'm going to format this as a number to 2 decimal places. Okay, so those are typical looking betas. Okay, so all good now. Now I have want the weights. So this is what we're going to input. And so I just want to start with something. So I think I have roughly, what is it, 30 assets. So I give them, if I give each of them 4% roughly, and then subtract and then cut out a few, that will get me roughly to equal weighted. So let me try that. 4%. Oops. Okay, this is the annoying part. Okay, so now, and then I want to start tracking some statistics. So I want to track, one thing I want to track is the budget constraint. So one thing is the sum of the weights. And that's a percent. So I should calculate this blue. So I've got too many. I want to little weight. Then the other thing I want to do is to calculate the excess return. So that's pretty easy. Ugh. So that's this guy times this guy. And then I want to format it like this. Okay, so 6.3, spelling mistake, fix, excess return. And to be really particular, I should say this is excess arithmetic return for the portfolio. And I want to know how many number of assets I have. So that's so that is equal to count. Just check if that's right. Yep. And then I want to, so yeah, so another thing to notice that you're provided with an illiquidity estimate. And so we can, there's an implicit objective as well. So it's not explicitly stated, but it's nicer to have like a lower liquidity than a higher liquidity, all else being equal. So the other thing we want to do is we want to make sure that we don't have a portfolio that's too illiquid. So we want to calculate an illiquidity metric. So that's kind of similar to this, except replace column H with F. Oh, let me do it. Okay, and this is just a metric, so it should be a number. Okay, so 3.08. Okay, so that's our starting point. Then the other thing is I want to know my weights to the asset categories. So weight to equities. And what's the last one? Active strategies. Okay, again, because I'm OCD, I'm gonna put those as blue. And what else do I want? Oh yeah, one other thing that's nice to do is to color these. So just to see what's already over the threshold. So let me just do that now. So oh, I didn't want to do that. Shit. Okay, and then I want to color these so that highlight cells greater than 3.5%. And then I'm going to just fill it, say blue. Okay, so then I'm going to do the same thing with the beta. So remember the condition was beta greater than 0.5. Okay, that was rather annoying. But anyway, so we want less than 0.5, right? So 0.5, custom format, go with orange. Okay, so now I've kind of got everything set up. So I got my weights, I'm over budget, that's fine. I got the thing. Oh, so one more thing I want to do is I want to say, okay, so now I've got everything set up, and now I'm going to start my portfolio construction approach. And there's many different approaches, but I'm just going to go through how I would look at it. So you see, like my kind of default behavior was to like equal weight everything. So that's kind of like my default starting point. But then I want to say that um, apply my kind of financial experience and have some views on how much weights I want to have to equities and fixed income alternatives and active strategies. So I want to essentially set targets here. So I'm thinking something like a 30-30-20-20 portfolio. So I'm going to put 30 target 30 here, just as a note. Target 30. Target 20. Target 20. So why oh, and let me make one more modification actually. So now I'm gonna so let me talk about like why I came up with this 30-30-20-20. So we talked about that the main risk premiums are the equity risk premium and fixed income risk premium. So these are the two main asset classes. And so we have like, decades, if not centuries worth of historical data showing that there's that's reasonable to have expect a positive risk premium for equities and fixed income. So whereas some of these other things don't have as long a history, and so my confidence in these asset classes are less. Let me go even a little bit further in saying active strategies, there's only 4 of them, and I have even less confidence in those. So I'm actually going to tweak my weighting a little bit more and say I'm going to have a weight of 25% in alternatives and 15% in the active strategies. So those are my targets. And you could argue, well, how about 35, 25, whatever? Yeah, like anything would be reasonable. I would think like 100 0 is not reasonable. But if you did 50 equities and fixed income, and you said, like my investment belief is I don't believe these other asset classes have persistent risk premiums, or they're too liquid, or the fees are too high, that would also be a reasonable approach. What would not be a reasonable approach is to say have 100% in active strategies, or 100% in alternatives. And even if you look at the Yale endowment, that's one of the most alternative heavy portfolios out there. But even that portfolio will have a reasonably large weight to public equities. So now I've kind of got everything set up. So let me make a couple of observations too, because these asset classes, you see, well, why are these asset classes grouped together? And so you see equities generally have higher return. So it's like they're almost all of them meet a return requirement, but they also have high beta. So that's the trade-off. So high returns, but high betas. Fixed income is the opposite. It's generally like lower returns, but lower betas, which is good for us. And then what you find is alternatives tend to try to offer you the best of both worlds, that which is almost why they're called alternatives, that they give you both high returns and low correlation to equities. And then you see that the active strategies, not only do they give you both the return and the high return and low beta, but they're also liquid. So I don't know if you can tell from this, but the scale is from like 5 being mostly liquid and 1 being the most liquid. So it's almost as if like the active strategies are a little bit too good to be true. So in other words, like every single one exceeds all your targets plus is fully liquid. So So now I'm going to go through them. So that's why like I'm saying like, yeah, like it looks really good on paper, but I don't have the same level of conviction as I do in equities. So now I've got my categories. Now what I'm going to start to do is to see if there's anything I want to get rid of, or even to start reweighting. So one thing I would, within the active strategy, since I'm actually already so close to the weight, 16%, so maybe I might well do this one right away. So there's momentum, carry, volatility selling, and value. So out of that, what sticks out to me as most risky is the volatility selling one. And you guys are going to do, your assignment 3 is going to be on tail hedging. And we talked about the Aimco lost $2 billion on their volatility selling strategy. And so the characteristic of volatility selling strategy is that you make a small amount of money, but then you lose a lot of money all at once. And so the idea of that kind of strategy is that all those times you make a little bit of money, more than compensates you for the losses. If you think about that, that's very much like an insurance type model. So let's say an insurance company sells fire insurance, and so they collect a little bit of money every single year, and after a while they've collected so much money that they can afford to pay out in a fire. So that's what volatility selling is. But the success of it very much depends on you pricing the cost of that insurance. And also it has a characteristic of losing a lot of money right when the market crashes, which is exactly the opposite when you want to lose a lot of money. So I'm going to actually zero out that strategy as unattractive. So I don't want to have anything to do with that strategy. And then the other ones are fine, but I want a 15% weight, so that's pretty easy. I go 5, 5, and 5. So I've met my target there. And then when I go through this, so one of the things that also I can eliminate is fund of funds. And when we do our second portfolio construction exercise, you'll see this in more detail. But if you compare fund of funds to hedge funds, so it has a lower return, it has a worse Sharpe ratio, it has slightly lower volatility, so that's good. But the thing is that the Sharpe ratio is almost half. So the volatility reduction doesn't offset the lower return. It's like the correlation is close enough. It's like 2.7, 2.5 is pretty much the same thing. What that means is the fund of funds is really just hedge funds with an extra layer of fees. And so I'm going to take the perspective of an institution that has ability to do direct investing in hedge funds. So I'm going to zero that out. And then what else? Yeah, I'm going to zero art out because even though it has nice correlation properties, in other words, it acts as a hedge, but the size of the market is not very big, and so there's not enough capacity in this. So I'm going to cut that one out too. What else? Oh, obviously I'm not going to, this is, the exercise here is to construct a portfolio of risky securities. So I don't want to include the risk-free assets in my portfolio. So remember, I'm trying to, like, in the back of my mind, I'm trying to construct, like, the maximum Sharpe ratio portfolio. So I wouldn't have the risk-free asset in there. And obviously T-bill is just a slightly worse version of cash. So I'm going to delete those two. And nothing else jumps out at me as necessarily bad. So now I'm going to look at my weights. So I'm at 28% for equity, so I'm almost there. And if I had to look through these and figure out, okay, well, which one is not so nice to underweight a little bit, the global developed is only one not making my return target, and it doesn't have, the beta is kind of normal. Like it's almost by definition is 1. So I'm going to underweight this guy, make this 2%. Oh, sorry, other way around. I want to add 2%. So now it's the opposite exercise. I want to add 2% to somebody else. So what's my best looking thing? Probably small cap value. Yeah, it's got the best Sharpe. correlation is pretty good. So I'm going to overweight this by 2%. So I'm going to give it a 6% weight. So now I've matched my equities. Now I just have to bump up fixed income a little bit. So I'm going to want to overweight some guys by, I have kind of 6% to spend. So I can make this 7. I can make this 7. And the reason I picked those are two that are both meeting my return target or exceeding my return target and my beta target. So I'm kind of overweighting to those. So I'm being a little bit aggressive in my portfolio. Oh, well, actually, one thing I haven't addressed is my illiquidity is pretty high here. So I want to actually get that down. So this is where I'm going to start to make some trade-offs. So the equities are pretty liquid. The fixed income is pretty liquid. These were pretty liquid. But once I start getting the alternatives, this is where I got like a lot of very liquid assets. So I'm just going to say, okay, even though the returns are attractive, I want to give up some of the returns to have a more liquid portfolio. So I'm going to zero out the most of the liquid guys. So all the 5s. Okay, so now I'm going to see where do I land now. So actually I'm almost there. So, and my liquidity number went down from 2.9 or something up to 2.27. So that's not too bad. What else could I cut out? So I wouldn't want to cut out hedge funds because they have the highest Sharpe ratio, although they're pretty liquid. Let's look at US REITs versus US property. So those give me similar exposure. So one is almost like, see, the idea is that the US REITs is more like a liquid version of the private real estate. So maybe I could, oh, actually I want to add 1% more. So sorry, I have 1% to spend, not to cut. Okay, so then that's pretty straightforward. I'll put it in hedge funds because it has a high Sharpe ratio, the 5. Okay, so there we go. So I've met these constraints. I've met the requirements. I'm fully invested. Oh, actually, one thing I didn't calculate was the beta. So let me insert that here. Okay, so portfolio beta, that's okay. I want this as a number. Okay, so actually, I'm not that thrilled with that beta. That's actually pretty close to the constraint, but yeah. Oh, that's fine. Okay, so if I was doing this exercise, this would be like a contender for what I would submit. So you can see it's like pretty well diversified, both across the strategies and then within strategies. It exceeds the return requirement. It exceeds the beta requirement, although not by that much. And it's as a 2.3 illiquidity metric, which seems reasonable enough. It's not like that illiquid, so all looks good to me. And so so that would be the exercise. So I'll just like save this as the complete exercise. So now let me turn the focus to my notes just to make sure I don't miss any of the points I wanted to make. And then we'll take a break. Okay. So yeah, here's the thing. This is my little cheat sheet. Yeah, so here's just a clue if you were doing this exercise. that you want to look for high Sharpe ratio, low correlation combinations. So those would be small value, global government, hedge funds, momentum. Yeah, and then here's some of the things that this jumped out at me is odd. Actually, here's one thing that's interesting to note. This is a good exercise when you sanity check any of these asset forecasts. You ask what's the implied equity risk premium, because we've gone through this exercise and I told you that a reasonable equity risk premium is about 3%. So if I go look through this data, and if I say take geometric return, so 8.5 for domestic equities versus U.S. U.S. Treasuries, 6.8. So what's that, like 1.7 or something? Yeah, 1.7 equity risk premium. So this particular data, so this is historical data. So it's not forward-looking, but we're just interpreting it. So when we did this exercise, we were interpreting these historical numbers as if they were forward-looking expectations. Having said that, when I look at this historical data, it looks like, for whatever reason, over this period of time, so 1990 to 2009, fixed income did better relative to equities than you would have normally expected. So in other words, the equity risk premium was low. And that actually makes sense because yields have declined over this period of time. So that's made fixed income outperform relative to what you normally expect. So if I was doing this more thoroughly, I would massage this data to convert it into more forward-looking expectations. So I might modify the formulas so that the return for U.S. Treasuries was, say, 3% less than the return for equities. Yeah, and then what's fun about this exercise is that it's not like a heavily constrained problem, meaning that there are probably like an infinite number of solutions that meet the constraints. And so that means you have some freedom to choose the construction approach that you want. And so we could have done equally weighting, which is just essentially how I started. You could do equal vol weighting, and I derived the formula for that for you. Another strategy would be to say, okay, I'm going to pick the best within each of the categories. That's a reasonable approach. You might not be that diversified because you only have 4 assets, but you get the idea. Another thing that we didn't, that I kind of mentioned throughout the exercise, but I didn't explicitly state was if you're doing this exercise, probably the very first question you should ask is who's this portfolio for? Because the answer is going to be very different than if you're doing it as a sophisticated large institution, such as like a multi-billion-dollar endowment or pension plan or sovereign wealth fund, or if it's just like a retail investor, and then the portfolio would look very different. The other thing when you construct this portfolio is that to take into account the investor preferences. So we don't really know if we're building this portfolio on behalf of somebody that they would rather give up some return in exchange for a more liquid portfolio, if they want if they want to maximize their risk-adjusted returns regardless of liquidity. Do they want something that's simple to manage? For example, like if you're allocating to hedge funds, that's quite a labor-intensive process. You have to visit managers, and you have to do due diligence. You have to read through legal documentation. Whereas if you just want to build like a 60-40 portfolio, that takes about literally 2 minutes on discount brokerage. You just simply buy like 2 ETFs and you're done. The other thing is that I made the observation that the active strategies looked really good in the sense that even those all by themselves met the requirements. So the question is, well, why don't you just have a single asset class or a single asset class portfolio? And you say, well, the answer is obvious. It's because you're giving up all the benefit of diversification. I remember Svensson said, that the only free lunch in finance is diversification. So it seems kind of obvious. But then think about this: how many people do you know whose portfolio is really just a collection of stocks? So in other words, not only do they not even consider any other asset classes, but even within stocks, they're actually just like concentrating on certain names. So, and it's most typically like names that they've heard of. Uh, so they may have like, 10 stocks, like all well known. Maybe they're all in the tech sector, or they're all like, so 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 you'd be surprised at how many people um, don't have any concept of a proper portfolio construction, and they don't even consider any of these other asset classes like convertible bonds, emerging market debt, uh, high yield bonds, all these kind of things which can reduce the volatility of your portfolio and build a better portfolio. So the last thing before we take a break is, are there any asset classes that are missing from here, considering that the list was built 2009? So one obvious one that jumps out to me is gold, and because there's been a lot of essentially printing of money, a lot of people have been thinking that gold is a good investment to protect against currency devaluations. So that's something that might be in a more modern list of asset class choices. There's no crypto on here, so you could argue whether that's qualifies as an asset class yet or not. But yeah, the one that jumped out at me was gold. Okay, so that was a pretty uh, concentration requiring exercise. So let's take a long break, and we'll come back at 7:20. Okay, so before we go to break, I'm gonna stop sharing and give you guys a chance to ask any questions. Okay. Any questions before we go for break? Okay. So, and yeah, obviously you can always message me and email me. And I'm going to put you all back on mute, and then I'm going to stop my video and audio, but and then I'll come back at 7:20. Okay, so see you soon. Qualitative lecture, and that's in two parts. We'll talk about the asset classes other than equity and fixed income, and then we'll talk a little bit more detail about hedge funds, and I'll give you an example of or discussion why hedge funds look really good in a mean variance sense. but I'll give you a sample calculation of hedge fund fees and show you how hedge funds, maybe on a forward-looking basis, may not be such a great investment. And then we'll take a break, and then I'll wrap up with this an example of visualizing the importance of visualizing your data. And then I'll take up a sample question from the exam. And this time the topic is investments. Okay, so let me start sharing the slides. Okay. So we talked about equity and fixed income, and then these are the two core assets. So, and in fact, you can think of it very broadly as equity is owning and fixed income is lending. And then we have other traditional asset classes. So credit, which is a little bit of a mixture between equity and fixed income. REITs, which is the publicly listed version of commercial real estate. Emerging markets, inflation-linked bonds, mortgage-backed securities. And then along with traditional asset classes, we also have this idea of alternative asset classes. And so this says, well, alternative to what? And it's alternative to these traditional asset classes. And from these traditional asset classes, so before we get into a survey of some of the alternative asset classes, we'll just go through and list the risk premiums that you can extract from the traditional asset classes. So from equity, it's pretty obvious, it's the equity risk premium. Fixed income, it's the term and inflation premium. Credit, it's the spread and default premium. Real estate, it's or REITs, it's a real estate risk premium. Emerging markets, it's a developing market risk premium. Inflation-linked bonds, it's a real yield. And in mortgage-backed securities, it's a prepayment. Okay, and then there's two different ways that alternative investments are used in the asset management space. One is a broad definition, and so that includes things like private equity, real estate, hedge funds. So those are the major alternatives. And then you've got some of the less common alternatives, such as infrastructure, timber, natural resources, commodities, and precious metals. And in fact, teachers invest in on all of these, both the major alternatives and the other alternatives. And then there's a more narrow definition when people say alternatives. Sometimes they just mean hedge funds. And just to give you some insight on what's the distinction between an alternative investment and a traditional investment. So it's not so black and white. It's more of a continuum, and there's different ways to express that continuum. So one way is that there's traditional asset classes, then there's kind of an intermediate state, and then there's alternative assets. You could also classify it as beta, alternative beta, alpha, or passive, or semi-passive to active. And a lot of times you find, and this is why we talk about alpha being rare and valuable, is that what initially starts as alpha tends to become commoditized over time. So something will start as alpha, and then people will understand how it works more, and it'll get packaged up into a semi-convenient investment process, and then it'll become like an alternative beta, and then it just becomes kind of common knowledge and well accepted, and then it's just a regular beta. So, for example, value and growth used to be sources of alpha, and now they're at the very least they're alternative beta. I could probably even argue that it's probably like beta now. So, because I think so many people are familiar with value and growth, and there's so many like, ETFs that will give you growth or value. Another good example is that a few decades ago, it was harder to invest in commodities such as oil, which you've studied in detail by now, or precious metals. But now that those are being packaged into ETFs, which means that they trade on a stock exchange, and essentially you can buy these commodities essentially as you'd buy a stock. So these have evolved from alternative asset classes to more traditional asset classes. And this is just from this actually came from an investment bank, but they were categorizing the risk premia that they monitor. So commodities, emerging market equities, Russell 3000. I'm not sure if that's small cap or is that the full U.S. market. I'm pretty sure the Russell 2000 is small cap. The Russell 1000 is the 1000 largest. So this is probably the entire market. Yeah, FX, fixed income. So they have mortgages, emerging market credit, various rates, volatility. So just to give you a flavor, there's a whole menu of these risk premia. And then you've probably heard about the Fama-French factors and probably like other types of factors that you may be able to extract from equities. And so yeah, one of the reasons why you see these is because there's such a long history of equities trading, and there's actually pretty good data as well. So that data allows people to do these kind of studies and look for these kind of risk premia. And so the original ones that Fama-French found, so along with the market factor, so that's basically, investing in the S&P 500, they found that if you construct portfolios, like long short portfolios, so you go long the small caps, short the large cap names, and then you track the performance over time of that long short portfolio, that will have a positive return. And so that's identified as a small cap risk premium. Similarly with value, you would go long portfolios, go long a portfolio of stocks that have low price to earnings, and short a portfolio of stocks with high price to earnings ratios. Momentum, and then subsequent to those original two factors, then some other factors have been identified. In fact, this is like identifying factors is a bit of a cottage industry in finance. And somebody wrote a paper on this topic and said that there's like, thousands of factors that have been identified. But the thing is, the vast majority of them are statistically not significant. So they're either just noise, or they're kind of combinations of other premiums, other previously known premiums, or they're just like random luck. So you know that story, like a 5% confidence means that 1 out of 20 cases is like a false. So a whole bunch are just statistically not meaningful. But here's a few that are probably have a little bit more credibility. So there's a momentum factor. I think that was one of the next ones that was discovered. And so that's where you essentially buy the winners and short the losers, whereas the winners being defined as stocks that are on the short term have trended upwards in terms of returns, and obviously losers ones trending downwards. And for all these factors, it's nice to have a rationale for why these work, like what type of inefficiency are you exploiting here. So for example, for momentum, the argument is that news is not fully incorporated into the prices of stocks. And so that's why stocks tend to trend. So good news will come out and the market won't fully price in that good news. They'll kind of discount it a little bit, and then the good news slowly gets incorporated. Similarly with bad news. And then there's low beta stocks. So we during the case, we did an exercise of calculating the beta of various asset classes, but you can do that for individual stocks. So you have typically like utilities would be like low beta stocks, and say tech would be high beta stocks. And the rationale behind this is that some investors are constrained that they're not able to leverage their portfolio. So instead of explicitly leveraging their portfolio, they will overpay for high beta stocks. And so what that means is that if you are able to leverage, you're actually better off getting a portfolio of low beta stocks and leveraging that up so it has like a market beta. So you know, if your portfolio had a beta of like 0.5, you'd leverage it 2 times, you get a beta of 1. So it should have the same return as the market, and then whatever extra risk premium you get from the low beta tilt. And then the last one is illiquidity, so that you know, stocks that are more liquid should give a risk premium for taking on that illiquidity risk. And even like, you know, reminding you back from the very first case that we did, we talked about microcap stocks having a bid-ask spread of 10%. And so you need to get rewarded for taking on that large bid-ask spread. Okay, so here's this part I would normally break, and we'd watch a couple of YouTube videos. And one of the problems with these factors and finance in general is that it's a very like abstract topic. So it's hard to visualize, you know, like what these risk premiums look like. And so this asset management firm had the same thought, and what they did was they actually commissioned some artwork to visualize what these factors mean. So they had a painting for representing the value factor, the momentum factor, the credit spread factor, the term premium factor, and small cap and value. Actually, they may not have a value. They may not have done momentum, but anyway, yeah, I think they did the market risk premium, value, small cap, credit spread, and the fixed income term premium. So those were the 5 paintings. And every single year, I would show them talking about how they came up with the idea to visualize these factors, and but it turns out that this year they made the videos private, so we can't enjoy these guys' artwork, which is rather unfortunate. I tried Googling if I could find them, but it's not. I can't find it. So hopefully the videos aren't private because they're out of business. Like hopefully they're just like, for some reason, maybe they noticed every single year there's a spike in views, and they're kind of suspicious, so they made them private. Anyway, so we don't have the benefit of those visualizations. So now let me, so we've talked about the traditional asset classes, alternative asset classes. We talked about there's a continuum from alternative asset classes, traditional asset classes, and that's typically the evolution from things being at alpha evolving into beta. So now we turn our attention into one of the alternative assets, which is hedge funds. And one of the things about hedge funds is that they historically had a high Sharpe ratio, which means that if you feed hedge funds into an optimizer, it will give a large weight to hedge funds. Now, that's not a very sophisticated analysis, because hedge funds, by their very nature, are engineered to deliver high Sharpe ratio. But they do that at the expense of some of the higher order moments. So there's skewness and kurtosis. So for example, like a volatility selling strategy has a huge skewness. So whereas that might be embedded, like a hedge fund may be following like an insurance selling type strategy, and that would have like a very high Sharpe ratio until something blew up. The great example of that, not as a hedge fund example, but as like as similar to the oil ETF that you looked at, is the VIX ETF. So there was actually an inverse VIX ETF, so similar to the inverse oil one. And what happened is it had an excellent Sharpe ratio, and it was like steadily accrue money because it was expecting the volatility premium. and then volatility spiked, and what ended up happening was it blew up the ETF, and I think it didn't technically go negative in price, but I think it dropped from I think the ticker symbol was XVIX, I think, but don't quote me on that. But it went to it dropped by 80% in overnight. So what ended up doing is they ended up shutting down that particular ETF. There's still some volatility or inverse volatility ETFs listed, but essentially that it was essentially a trade, and it was a trade where you pick up the implied vol. So you're selling insurance, and it was like something like a $3 billion trade. So if you added all the assets up into these ETFs, inverse ETFs, it was like $3 billion. And then essentially 80% of that got wiped out overnight. And so it was a much smaller strategy after that. And some of these ETFs shut down. But anyway, so I'm drifting off topic. Getting back on topic, the point is that hedge funds are engineered to have a high Sharpe ratio, which is a ratio of the first two moments. So the first moment is the mean or expected return, and the second moment is the volatility. Whereas it may have a high Sharpe ratio because it has worse higher moments. So you have to be careful, and so that's yet one more reason why mean variance, which almost embedded within its name, it only cares about the first two moments, is not sophisticated enough to handle hedge funds. So then the question is, well, where should hedge funds belong? Like, do they belong at an asset class level? In other words, like, if you have like, or an allocation to equities, you should have at the same level, you should have an allocation to hedge funds. Or do you view it as like kind of like a sub asset class of something else? Or do you view it as this like a like a long short overlay on top of your traditional or core portfolio? So in other words, maybe you have 100% invested in a core portfolio, and then you go out and borrow 20% and use that to buy 20% of hedge funds, with the idea being that hedge funds should be generating alpha on top of that, and so they would add a little bit extra return to your core portfolio. That's what this core satellite concept is. So yeah, so this is kind of what I was saying about the higher moments. So even if you did the optimizer and then said, oh, you should put in like say 15% into hedge funds, and then what happens in practice is people say, well, because they're liquid and because they have these tail risks, these higher moments, and because sometimes they smooth their valuations because they don't have necessarily like 100% traded assets. For all those reasons, the weight to hedge funds is lowered. Okay, so then yeah. So the key idea or the key investment rationale for investing in hedge funds is because they generate alpha. So in other words, they generate excess return above the risk-free rate. And the thing about, remember we talked about metrics being like deterministic or statistical. And the thing is you have to keep in mind is like, you hear the word alpha thrown around a lot in asset management. But what people don't appreciate is that because it's such a commonly used term, is that it's actually a statistical quantity, which means that there's kind of issues with how you measure it, and it's kind of like not so certain. Whereas like return for portfolio is like it's just a number; it is what it is. Whereas alpha, it depends a lot on how it's measured and how it's interpreted. And so, as you know, alpha is the outcome from a regression, either a single factor or multi-factor regression. And depending on how you do that regression, you guys are probably familiar of courses in this. There's all kinds of issues with either missing factors or extra factors, all kinds of issues. So that means that if you ever are involved as a quant analyst in evaluating hedge funds, one of the tasks that you're going to have is most likely is to evaluate the alpha for these hedge funds and apply your statistical and financial knowledge to that process. And so just to give you some thoughts, so over time, people will start to understand a hedge fund strategy in more detail. And I've talked before about like alpha decaying, and it's a constant evolution, or it's a constant arms race. So in other words, the first generation of your strategy, after a while, people will start to understand it and be able to mimic it in some kind of algorithm. And so you have to have like a second generation, third generation, if you want to have a viable hedge fund business. So some examples of early strategies that became easily replicable is like merger arbitrage, convertible arbitrage, equity long short, managed futures. And I won't go into it in detail here, but in the lectures, there's a couple of upcoming lectures where we drilled into generating alpha or generating value add, and I'll get into the details of exactly how these strategies can be replicated. But for now, keep in mind that the benchmark for a hedge fund idealistically should be not relative to the risk-free rate, but it should be relative to the simple replication strategy for that mimics that hedge fund. And that makes it much harder for these hedge funds to actually beat that benchmark or to generate true alpha. Because otherwise what happens is the institutional investor themselves will just run an internal trading desk program to replicate these strategies. And indeed that's the trading desks and teachers and other pension plans, they're engaged in these kind of strategies. Okay, and so one thing I want to address is about the fees for hedge funds. And so this is an important topic. It also applies to private equity, but we'll just use hedge funds as the example because it's a little bit simpler. And so you may have heard the phrase like 2 and 20. And so we're going to go into a little bit more detail of what that means. And so 2 and 20 means a 2% management fee, and 20% means 20% on the share of the profits after paying the management fee. So in other words, if you give if you allocate $100 to the hedge fund, they will charge you 2% or $2 for a management fee every single year. And then let's say they returned 12%, so they earned $12. Then you'd pay $2 out of that, left with $10 of P&L after fees, and then the manager would take 20% of that $10, or in other words, an additional $2. So that hedge fund in total fees has taken $4 or 4% out of the 12%. So in other words, the return has been shared 1/3, 2/3. So 1/3 to the manager, 2/3 to the investor. But if you look at it a little bit more sophisticated way, part of that 12% was just the risk-free rate, and so nowadays the risk-free rate is pretty low. But as you saw in the first lecture, in the past it has been high, and so in the past it has been material enough to make the sharing even worse for the investor. So even worse than 2/3. The other thing to keep in mind for hedge funds is that you typically won't invest in a single hedge fund. Rather, you'll invest in a portfolio of hedge funds. And so what that means is that, let's say, out of, say, a portfolio of 50 hedge funds, in any particular year, maybe 10% of them will lose money and 40%, or sorry, like, yeah, say, sorry, out of 50 hedge funds, I'm using 50 because that's like a typical number for like a portfolio of hedge funds. So let's say 10 of those hedge fund managers had a negative return and the other 40 had a positive return. And so what ends up happening is that you pay fees, performance fees on the 40, but out of the 10 that lost money, you don't go to them and claw back a negative performance fee. So in other words, they don't compensate you for the losses, whereas all the other managers get to participate in the upside. And so that um, has an additional drag on your portfolio, which some people don't fully appreciate. That you as an investor have written like this basket of call options, so which is more valuable than a call option on the whole portfolio. And the call option on the whole portfolio would be as if you paid the performance fee on the overall performance of the portfolio. So let's say out of those 50 managers, the performance was in aggregate was negative for 1 year. That would mean none of the managers would get a performance fee. But that's not how it works. Because it doesn't work that way, it means there's an additional performance drag due to this like non-netting of performance fees, which you have to take into account when evaluating a performance of a hedge fund portfolio. So let me just walk you through. I essentially did walk you through that example, but let me just kind of do it again. So the typical investor in hedge funds, and this is for nowadays. In olden days, it used to be higher, but now that hedge funds have become more institutionalized and more conservative investors, more conservative, the investors in hedge funds have become more conservative. So that means the return requirement is more like LIBOR plus 500 at the portfolio level. So if investors got LIBOR plus 500 in their hedge fund portfolio, they would be very happy. And so let's just walk through how that would be achieved. And so let's take an example where a hedge fund, a typical hedge fund would earn a gross return of 12%. And if you think about it, in today's environment, generating 12% year after year is actually pretty hard. So even this is quite a challenge. And then I already went through the example of after you subtract performance and management fee, that leaves the investor with an 8% return. And then I talk about the fee drag. So I estimate this to be 75 basis points. You can do a little toy model to figure out what that has been. So that gets you down to 7.25. And then the other thing is, it may be that when you aggregate a portfolio of hedge funds together, it will have still have some residual beta to the stock market. And if you want to be a real purist, you may actually end up tail hedging or hedging out the beta from your. I shouldn't necessarily call it tail hedges, but you may end up putting on hedges to neutralize the beta in that portfolio. And so let's say that could be a 2% drag. So but this is kind of optional. So when I go through my example and I use the 2018 numbers, when LIBOR was 2.25%, or that's the risk-free rate, the investor, what this is showing is that forget about putting on the extra hedging, the 2% hedging costs. So what this shows is for the investor to achieve their LIBOR plus 500 basis points or 5% on their hedge fund portfolio, that means each manager on average needs to be earning 12% growth. And so that's just an exercise to show you that it's actually pretty difficult to achieve the LIBOR plus 500 target. Now I put in an extra note here that said what LIBOR is today, it's like 40 basis points. So if I had to rework my example, what I would do is I would change it so that the hedge funds are now targeting a 10% gross return. So it's not 12% anymore, just because the risk-free rate is so low. So that would get you a 6% net, and then you subtract off like the 40 basis points for the LIBOR, and then the 75 basis point drag for the fee netting, and so that gets you to the LIBOR plus 5%. And if you want to be a purist and add some hedging costs, you get LIBOR plus 300 basis points. Okay, so the theme is so far being that hedge funds, both historically and on a Sharpe ratio basis, look like an attractive asset class. But we've shown that after you pay for the fees, that it can be tricky to um, meet your return targets. And the other thing is, and I'll show you a slide for this later, is that there's so much assets invested in hedge funds now that there's less market inefficiency to capture per hedge fund. So for all those things, for all those reasons, um, a lot of investors have been um, reviewing their hedge fund allocations and cutting down. And so one example is CalPERS, and so they ended up cutting their hedge fund portfolio. Actually, I wonder if I have a slide. Yeah. So um, CalPERS is it's a it's it's a large and successful pension plan obviously in the States, and a lot of people look to CalPERS for what they're doing. So they're kind of like a thought leader in the pension space. And so in 2015, they announced that they were going to exit from their hedge funds. And so then the question would be, would other investors follow? And so what this graph shows here was that prior to 2015, they tried to reshuffle. So if you notice that remember I said, remember doing the case where I said that the hedge funds are dominated, or sorry, the fund of funds are dominated by hedge funds. So in other words, fund of funds are just hedge funds with an extra layer of fees. And so you notice that CalPERS prior to 2015 and before their proposed reshuffling, they had almost 20% of their portfolio in fund of funds, which is kind of very, very expensive. So not only are you paying the manager fees, but you're paying the fund of fund fees, which are typically 1 in 10. And so you see where they said, oh, okay, we should actually not be paying all these extra fees. We can just go directly invest in these underlying hedge funds. And so you see that's what they've done. They said, okay, we're going to do more equity market neutral, more global macro, et cetera, et cetera. But even after that shuffling, they still decided that no, it's still not going to work out. So they cut their hedge funds. And so then, the question would be: is this going to trigger a redemption in hedge funds? And I think the jury, even though that was a while ago, is still kind of out on this topic. And so there are issues because you need to have. There's no point in having a small allocation to hedge funds like 2 to 4%, because as I've discussed before when we talked about the Yale portfolio and only having 10% alternatives, it's not really enough to move the needle, so to speak, at the portfolio level. So you need, on the one hand, you need to have a sufficiently large allocation to them, but on the other hand, though, the average hedge fund performance is poor, and there's and you need a lot of sophistication to be able to separate out the good managers from the bad managers, and that means identifying alpha from beta. So, which is exactly the kind of roles that you guys will be doing. So, let me just see. Yeah, let me show you why the idea that the jury is still out. So, I want to show two concepts here. One is that the idea that early on, like when David Svensson was investing in hedge funds, there was hardly any assets in hedge funds. It was a very small space, so it was very easy to everybody to make a lot of money. And then as assets grew more and more, it became harder and harder to make money, but more and more assets went into the hedge fund space. And you can see like even from 1990 all the way up to like 2017, the assets continued to grow pretty well. And now, but if you look kind of at maybe more recent history, you could make the case it's like kind of leveling off a little bit. So that's what I mean by the kind of the jury is still out. Like the assets from between 2017 and 2018 actually dropped a little bit. Then they went up in 2019. But you got to remember, 2019 was a very good year for returns. So I think the S&P was up, was it like 30% or something? So a lot of this gain could have actually been returns. And in fact, it could have been that AUM actually, like investors took money out of hedge funds. And then we'll have to wait and see how 2020 does. So it could be that hedge funds are kind of, maybe stabilizing in terms of AUM size. But even having said that, I would make the argument that hedge funds actually have to shrink in size to return to an era where they generate net alpha for the investor. And so that's what I show on this slide here. I go through a little toy model and just say, okay, well, if the hedge fund AUM is about 3.5 trillion, and there's 35 billion of market inefficiency, aka alpha, available per year. And so that's actually just 1% true alpha available. And you could wonder, okay, where do you get this 35 billion from? And so you could kind of back it out by saying, okay, well, looking at the amount of alpha generated by hedge funds historically. And so you get the idea. In the early days, the alpha was very high, but the AM was very low. And then it kind of, that balance shifted, but the total amount of alpha roughly remained constant. So you could do an exercise like that. But for the sake of illustration, I picked a nice round number. And so each year there's a genuine amount of 1% available for hedge funds. But remember, there's a 2% management fee. And so some of those managers will manage to do well and earn a performance fee, and they may be doing that by blending in beta with the alpha. It could be that they're just genuinely skilled, but for every genuinely skilled manager, there's probably like offsetting managers that are losing money. So remember, there's this netting issue of fees, right? And so maybe it's a little bit of an overestimate, but just for the illustration purposes, out of that 1%, the investors end up paying roughly 4% in fees, which means there's a net negative alpha of 3% for the investor, which means that the average investor in hedge funds will earn negative 3% alpha, which is clearly not a good investment. And so you could debate whether the 3% is minus 3% is like -2 or -1, but the point is it's probably like a zero or negative number, which means that for you to justify having a hedge fund allocation, you have to be able to say that I think I have sufficient skill to select managers like to select the managers that are generating true alpha. But that's a difficult claim to make. And so maybe if you're a sophisticated pension plan or endowment, like as such as Yale, maybe it is legitimate to make that claim. And in fact, implicitly, that's what they're doing, because they're holding on to their hedge fund allocation. Like you saw, Svensson still has allocation to hedge funds. So he's implicitly saying, even though the average expected return for a typical investor is negative, I, David Svensson, have a skill at picking the best managers. So I still think I can beat that zero hurdle. Okay, so that was everything I wanted to say about hedge funds. And so it's exactly 8 o'clock. So it's a good time to take a break. So I'm going to stop sharing, give you guys a chance to ask any questions, and then we'll take a break. We'll just take a quick break, 8:10, and then I'll wrap up with the exam question, and it should be maybe 20 minutes to wrap up, and then we can end at 8:30. So let me unmute everybody. Just checking in for questions. So there's no questions, then let's take a quick break, and I'll see you guys back at 8:10. Okay, thank you. And this is the idea, the same idea from my feedback on assignment 1, but the necessity of visualizing your data. And this is like a nice little example, because this is, I think it's like some math person, Anscombe, deliberately constructed this data set, or 4 different data sets that all had the, so one looks kind of perfectly reasonable, the first one, and then the other 3 data sets look like, you know, kind of odd. And the point is that all 4 data sets have the same statistics. So I think that means they have the same R squared, mean, slope, intercept, all those things. So if you were, and you know, like the R squared is like a metric of how, kind of how confident or how good your model is. Typically, people use it in that sense. And so if you said, oh yeah, like my R squared is really good because it looks like, you know, pretty high for this, like it's probably like a 0.7, 0.8 or something like that. All the other ones have the same R squared as well, yet they're not at all explained by your linear model. And so, you know, this is like a really nice illustration of how your data, unless you visualize it, you can fool you, because there's a lot of implicit assumptions in your data, like in terms of how it's distributed and its functional form. Like obviously this is quadratic, this has an outlier, this is clustered. So it's very easy to be tricked if you don't visualize your data. And this is particularly true because I think a lot of you guys would just like, you know, write your Python code and then just trust that your code logic and then your code just spits out a number, and you're not visualizing the process or seeing what's going on in the process along the way. And so you really have too much of a confidence in your inputs. So that's just a kind of a warning. Okay, so now we turn to the exam question. And I think I mentioned the exam is 6 questions. And let me just find my notes. Oh, that's not the right one. Of course. Sorry, give me a moment just to find my, I have them. I have it up on my screen. I can't figure out which one I'm supposed to click on. Okay, well, it's still not the right one. Okay, here we go. Yeah, so like I was saying, the exam, as I mentioned, has 6 questions. You answer 5 out of the 6, and they all cover different topics. So one topic is efficient and frontier. The other one is, I think, like a portfolio construction question, which so we've done those 2. The next topic is investments, and so this is an investments question. And it's actually, I found an interesting question. So the question is that you know, the more cultured amongst you will probably know that the Mona Lisa is housed in the Louvre in Paris, and the Louvre has decided to issue a million Mona coins, and So the coin, the question proposes two different interpretations for those coins. So one case is where the coin gives you a share of the ticket sales. And so if you own 10% of the Mona Lisa coins, you're entitled to 10% of the ticket sales to go see the Mona Lisa. And then another one is where the coin gives you a fractional ownership in the painting. So again, if you own 10% of the Mona coins, that means you own 10% of the Mona Lisa painting. And so the question is, how would you value the Mona coin under these two cases? And then the next question is discuss how you would extend this idea to a portfolio of cryptocurrencies linked to art, and discuss in this context what would concepts of diversification and weighting mean. And then the final question is whether such a portfolio fits within an institutional portfolio. So this is actually, I think, a deceptively good question in the sense that, well, obviously, like, I wrote it, but it's good in the sense that it sounds very specific, but it actually is asking about the two very broad approaches to security valuation. And so one form of valuation is essentially a discounted cash flow approach. So you estimate the future cash flows from the investment, and then you discount those back to the present using a discount rate appropriate to the riskiness of that investment. So a specific example of that is the Gordon growth model, or the dividend discount model, mean the same thing, but it's just a formula where the value for stock is the next year's dividend divided by the required equity return, subtract the growth rate. And so in our particular case, I'm going to assume that the ticket sales grow as inflation, so our growth is simply CPI. And if you want, you could actually plug in numbers into this and get an actual valuation, so you can make some estimate of what the ticket sales could be. But that's really, like, I'm not expecting to get into the details, but I do expect identification of the valuation approach of discounting future cash flows and having some idea of what rate to discount those at. And so, you know, you could ask, well, what should be the discount rate? And so I say, well, you could kind of wave your hands a little bit and say, well, it's not risk-free, because the Mona Lisa may get unpopular, or there may be some reason, like, you know, like a pandemic where the ticket sales are drop off. But generally speaking, like, it's probably like a relatively low risk environment, or low risk investment. It's not like you know, a company that's going to go bankrupt. Like, probably people are going to want to see the Mona Lisa for years to come. So I just throw out a number like 6%. So then so that's one broad approach to valuation, namely discounted cash flows. The other approach, and this approach is whenever you don't have explicit cash flows. So really, sometimes you'll own something with the idea of holding it for a period of time and selling it for a higher value in the future. So gold would be an example of that. Say like Bitcoin would be an example of that. So sometimes you have investments that don't have explicit cash flows. And so that's the case we're dealing with here. And in that case, then the valuation approach is like a comparables approach. And so this is where you would look around for similar transactions that have taken place recently. So you could ask, well, what exactly does similar mean? And so you could look at other Da Vinci works, and you could look at other famous works of art in general, and you could ballpark the price for that. So just before before this lecture, I looked up like the top 10 uh, highest sales for art, and it was actually the highest one was like in 2017. I have it in my notes. Is a Da Vinci painting sold for roughly $500 million, and I hadn't really heard of it. So I figure like the Mona Lisa's got to be worth like maybe 4 times as much as this one. And so I'd say like maybe the Mona Lisa is worth $2 billion, and then you could get your fractional valuation, as a fraction of that. So that actually kind of gives an explicit answer to the question. So yeah, but the reason why I think this is a good question is because it's really asking about the two approaches to valuation, namely discounted cash flow and comparables. And if you think about it, like comparables is also used for like if you're buying or selling a home, like you'll typically like, okay, what did other similar houses sell for in the area? Like that's exactly the comparables approach to valuation. So it's kind of intuitive for people. Okay, so then the next question is, what would diversification look like for a portfolio of art? And so you could diversify over famous artists, you could diversify over styles, you could diversify over eras, like it's like Renaissance, modern, postmodern, whatever they are. So you could see like, the same way you could structure a portfolio, of different asset classes or different sectors, you could do the same thing for art. So the concepts carry over. So the question was just, can you identify like kind of the equivalent in more abstract settings? And then the portfolio construction approach could be very much like similar, like you could equal weight to famous artists. You could equal weight to famous artists within styles. And then the final question, just to wrap up, is whether this would be appropriate for an institutional portfolio. And I think the answer is no. You don't actually typically see artwork as an asset class for institutional investors. So it may be appropriate for like high net worth individuals, but there's two aspects. Actually, it's kind of interesting question. Why don't institutional investors own art as an investment? And so there's two. I think I would identify two main reasons, perhaps a third one. But the main reason is the market size is just too small. So if you added up like all the top 10 most valuable paintings that have sold, I mean the Salvador or the Da Vinci one was like $500 million, but the one after that was more like 200 million, and they drop off relatively quickly. So it's probably like for a few $1 billion, you could buy the top 10 most valuable works of art that are at least that have actually transacted. And if you think about that, that's about like, that's not like that's just the top 10. But if I kept going down, you could probably buy the entire art world for the market cap of a mid-sized company. So maybe like like order of 10 to $100 billion. So the entire art market is just simply not big enough for to be a serious asset for an institutional investor. So in other words, of saying that is it's just simply not a big enough weighting in the market portfolio. In other words, the market portfolio is the universe of all assets. It's even like a more broad definition, but you could think of like market portfolio contains everything. So stocks, bonds, art, real estate. But some of those categories are just so small that it's not realistic to for an institutional portfolio to hold it. So that's one reason. The other reason that may not occur to you is that unlike gold, gold is fungible, so you can one piece of gold is the same as the other. So art is unique, and the thing is, you don't one of the issues of investing in art, particularly for an institution, is uh, the um, the kind of ownership pedigree of the artwork. So, and that could have split out into two issues. One issue is that it could be a forgery. So imagine, like, like, let's say, say for argument, Ontario Teachers spends $2 billion to buy the Mona Lisa. And then the next day somebody comes along and says, oh, I suspect the Mona Lisa that you bought is a fake. So what do you think the value of that investment would be worth, even with that cloud of doubt? So so that's one aspect, is that this fraud is too prevalent in the art market. The other issue is, imagine the same scenario, and then somebody comes along and says, oh, like, that Mona Lisa was stolen from my family in like the First World War, or like something like that. And again, like, what do you think the value for that artwork would be? So owning art, you're constantly having to defend against claims of fraud. You're constantly have to defend against claims of ownership. You probably have to pay for insurance and storage and all this kind of stuff. So all those things, if you think through it a little bit more deeply and in a practical sense, it's not a realistic asset class, although definitely would be fun. Anything else I want to say? No, I think that's everything. And yeah, that's pretty much it. It's almost 8:30, so I think it's a good time to wrap up. So I'm going to stop sharing and again open up to questions. Okay. And
Hey, Mark, I have a question actually.
yep.
So in the question we were just doing, I know teachers used to own like the Toronto Maple Leafs, right?
Yep.
So how would you sort of value something like that?
Yeah, that's a great question. So we actually owned Maple Leaf Sports and Entertainment, which meant we owned the Raptors, the Maple Leafs, and I think the football team as well, I guess soccer team, and we also owned, like, I think we owned like the arena as well, and we don't own it 100%. And this was but it was like in partnership with a few other partners, and we initially made the investment through our private capital department, and uh, private capital has a growth. So I'm actually answering the question like a little more broadly than you asked, but just to give you a little bit of background, because it's like quite interesting. So they have a growth requirement. So they need to generate like a pretty high return. So they target like 20 to 25% annually. And so what that means is you typically see those returns in the early growth stage of a business. And so the thinking was, after a certain point, the Maple Leaf Sports and Entertainment got to be a pretty mature business, and that they weren't seeing the same like 20 to 25% returns. It would be still good returns, but not as good. Now, we came to that conclusion before the Raptors won the championship, so that probably was not the best analysis looking back in hindsight. And also, speaking of it being a fun investment, it also meant that we had uh, executive seats, which are even better than like box seats. So box seats, I think, are at the back of the arena. Executive seats were like right on the floor, and so that was pretty cool. And so every now and again, you got like free tickets to the Raptors. But anyway, to get more to your question, so yeah, sports teams are very interesting investment, because it's not actually driven a lot or always by economics. Um, so, for example, what you find is it's kind of like a vanity asset for people. So you'll find like a lot of people like make a lot of wealth, and they'll be interested in buying a sports team. So but that's not teachers' point of view. Like, we're interested in it as an investment. But having said that, when you analyze this investment, you know in the back of your mind that you'll always have buyers that are kind of not financially motivated, but more like ego motivated. So you kind of have a feeling that gives you kind of comfort that there'll be some kind of liquidity if you ever wanted to sell the team. So that's one point, that it's not it's not like a pure like like the example I gave, it's not a pure discounted cash flow exercise. Like you figure out what TV revenues is, and I guess like paywall type revenue, and an arena and season ticket holders and like merchandise, and you add all that, you forecast out all that, and you discount it back, and you get a number. It's not quite like that, because you know that people will pay a premium for these sports teams. So that's the first comment. The other comment is that there are actually transactions for these teams, and so it's not like these things never trade. So there is uh, so you can actually apply the comparables approach. So I guess like to summarize the answer, more like your question you'd ask, you'd say, well, you could apply the most conservative valuation, you'd be the discounted cash flow valuation, and then you add on top of that kind of like a I don't know how to phrase it, but like a kind of like a buyer's premium, just because it's such a exciting and attractive asset. And then the second, so that's one approach that would give you a range. And then another approach, we just look at comparables. And yeah, and also too, like it's almost similar to the Mona Lisa example, because I think at the time we did the investment, the main asset was the Toronto Maple Leafs, and it was almost like the Mona Lisa of sports teams, in the sense that it was like the most valuable hockey team. So that, yeah, I mean, the transactions for the other teams would just have created like a lower bound, but you had to come up with like, okay, what was actually the most valuable team worth? Just because like it's amazing like how much money people will pay for like hockey tickets in Toronto versus like other U.S. cities. So yeah, I think that's like a pretty complete answer to your question, I think.
Yeah, thank you.
Anything else? Okay, so I'll say good night for those in my time zone, and I'll see you guys tomorrow. And I'm just thinking, I believe your assignment is due tomorrow, right? And then I hand you out the next assignment, and then that one is you'll have till Friday to do that, and then the exam is on Monday. So we're flying through at the halfway point now. Okay, thank you, everybody. Talk to you later. Bye.